always going to be identifying the trend direction so that you can get your clear directional bias, whether price is bullish or bearish. So in this case, we see price goes up, pulls back, and then goes up and breaks structure, right? So obviously this is bullish because we literally got a bullish break of structure to the upside. Price has just broke through this wick high right here. So now, after a break of structure, we're anticipating price to start pulling back. And we know that in a bullish market structure just like this, we are trying to capture this new higher low so that we can trade in continuation with that overall bullish trend direction. So that's always going to be the first step, right? You want to identify your trend direction by mapping out your market structure to determine whether price is bullish or bearish. And ideally, you want to trade in alignment with that overall trend direction, right? So in this case, once you have identified your trend direction, the second step is to just determine your point of interest, to map out your supply and demand zones or your order block or flip zones, whatever point of interest that you want to be trading from. Because if you don't clearly define your point of interest, you're going to be taking a bunch of random trades at anywhere when price is in the middle of nowhere. And these are all low probability setups, right? So we want to mark out our point of interest, and in this case, we saw that there's only one demand zone right here, right? This is the extreme demand zone that led to the break of structure, right? But obviously sometimes price is not going to be so straight up like this, right? Price can goes up, pulls back, and then create like a minor pullback just like this. And in that case, there will be a demand zone here, and then there will be a demand zone here, right? So you basically want to map out all your point of interest on the medium time frame, right? Which could be the 4-hour time frame for you if you are a swing trader, or it could be like a 15-minute time frame for you if you are a scalper. So once you have clearly defined your point of interest, the next step is to just wait for price to mitigate that point of interest, right? So I will actually advise you to set an alert at the edge of the zones itself. At the edge of this demand zone, once price tap into it, that is where my alert goes off. I'll go and analyze the charts and look at my entry model. Okay, here's the magical part, and this is really like the secret on how you can get those sniper precise entries. Once price mitigate your point of interest, that is where you want to look for this entry model itself. It's called the fake market shift entry model. So basically during this pullback phase right here, we want to see some form of strong liquidation, right? What the hell is strong liquidation? What are you actually yapping about, Brad? So a strong liquidation occurs when price actually liquidate a strong low or a strong high. Here's what I mean. Right, price doing this pullback just like this, we know that price have shifted bearish, which means price is creating lower highs, lower lows, lower highs, lower lows, right? So in a bearish scenario just like this, all these highs are strong highs, right? Because it's strong highs that led to price breaking past the wick lows, right? So all of these are strong highs. And then later on, price actually came down here, right? It came near the point of interest, and then it actually went up there and take out our strong high. When this actually happens, we know that this is a market shift, which confirmed to us that there could potentially be like a shift in structure. But in this case, this was just a fake market shift, right? Because what happened is that price actually came up there, swept the available liquidity above this high right here for price to continue going down even further, right? So this is what we call a fake market shift. Because if this market shift were to do its job, price will actually start creating higher highs and higher lows, and then this will be that new higher low in this overall swing structure, right? In this overall bullish trend direction. Okay, but that did not happen because the bearish internal structure continued, right? Which means that price is still pulling back even deeper into potentially this extreme demand zone that we have right here. When this actually happens, right, when you get a fake market shift just like this low becomes a strong low, right? It's no longer a weak low because this low led to price breaking past that strong high, right? So making this a strong low, which means that it's going to be a lot of available liquidity below this strong low. Because what happened is that a lot of retail traders, they're going to be entering for a buy like somewhere right around here. Once they see that market shift, they think that, oh, the pullback is over and right now we're going to go to the moon. So I'm going to enter for a buy right here and I'm going to place my stop loss below this low like a stupid retail trader. And when that happened, this build up available liquidity below the strong lows right here. Because you must understand that if they're entering for a buy right here, and if they get stopped out, their buy orders get converted into sell orders. What this means is that if you are a smart money, right? If you are the big banks, the financial institutions, and you want to enter for a large amount of buy orders at this demand zone, but there is no one on the opposing side to fulfill your large amount of buy orders because no one has billions of dollars just sitting around their house, you need some form of liquidity. And where are you going to get the liquidity from? You're going to get it from the retail traders' stop losses, right? Because remember, if they get stopped out, if all these retail buyers get stopped out, their buy orders get converted into sell orders, which is able to fulfill the smart money's large amount of buy orders. Boom, magic. This is exactly why sometimes smart money will actually do this shit, right? They will manipulate price, cause this fake market shift just to build up more available liquidity below this low, and then later on price will come down there and they will swap all the available liquidity below this low, and then the real move will actually happen to the upside because now they actually have sufficient liquidity to move the market in their favor. So this is where you actually want to enter into the trade. You want to enter upon strong liquidation, right? Which means upon this fake market shift during the pullback phase itself. Okay, so just a quick recap. The first thing is to identify a trend direction, right? So in this case, we saw that this is the bullish break of structure, and now we are anticipating price to pull back. And where is price going to pull back to? That is where we have to mark up our point of interest. We see that there's our demand zone right here, potentially another demand zone right here, and now we want to wait for price to pull back and mitigate either one of these demand zones. And then once it does, we want to look for our entry model, which is our fake market shift entry model itself, right? So in this case, price started pulling back. And in this case, since this is the only demand zone, right, we are not doing anything until price mitigate that demand zone. Once price mitigate the demand zone, that is where I want to look at the pullback phase itself, and I want to see whether I got my entry model, right? Whether there was any strong liquidation in the form of fake market shift. If there is, cool, that is where I can start looking for my entry. And when I start looking for my entry, there's two types of entries that you can actually deploy. One is called the aggressive entry and the other is called the conservative entry. Once again, this depends on your risk tolerance and your personality, right? If you are more conservative, you want to play it safe, you want to like have the most safest route, by all means go ahead, use the conservative entry. If you are more aggressive, you want to get in as soon as possible after price swap the available liquidity below this low, then that is where you can use the aggressive entry. Just take note that if you use the aggressive entry, what can potentially happen is that price can continue going down even further, right, before we get a strong move to the upside, right? Let me just explain to you what are the differences between these two entries. First of all, the aggressive entry states that you want to enter upon the candlestick that swap liquidity, right? So in this case, we know that there is strong available liquidity below this strong low right here, right? So we want to see price swap that low. So once price actually break past this low right here, there is going to be a candlestick, right? So this is what we call the candlestick that swap liquidity. So you want to wait for the candlestick that swap liquidity to close, and then you want to place a buy stop order above the candlestick itself. Hopefully, when price actually start reverse and go up, you get tapped into the trade just like this. Okay. On the other hand, you got your conservative entry, which says that you need to wait for extra confirmation before you actually enter for the trade, right? Which means you want to wait for some form of market shift to confirm that's a shift in structure or some form of flip, right? Some form of failed reaction. So in this case, this is the nearest lower high that led to that liquidation itself, right? So we want to wait for this lower high to get broken to confirm to us that, you know what, the pullback is over and right now we are moving to the upside. Okay, so in this case, once you got a market shift right here, that is where you can wait for price to pull back to your lower time frame demand zone that led to this market shift itself, and then that is where you can look for your entry. As simple as that. This is your confirmation entry. This is your conservative entry. You basically want to identify the nearest structural lower high. You want to see that get broken to confirm to you that right now the demand has overpowered supply. And then you want to wait for price to pull back to that demand zone that led to the market shift itself, and then that is where you want to look for your entry. Once again, you must understand that there's pros and cons to the conservative entry and the aggressive entry. The